Is the current dip a potential new entry points for new heights? What's the long-term cause and effect of Trump tariffs and Fed cuts? And most importantly, what does this all mean for investors in 2025? My name is Peter and I'm a senior analyst at TradingKey.com. I'll be sharing 10 promising stocks you should definitely pay attention to in 2025. Before diving into the US stock market outlook, let me take a quick look at the current macroeconomic environment and explore how these dynamics could potentially impact the industries you're considering right now. Since Trump took office in January, his words and actions have caused turmoil in the markets. His America First policy, erratic decision-making, and business-oriented governance marked an extraordinary period for the US and the world. On April 2nd, President Trump signed an executive order introducing a sweeping reciprocal tariff policy affecting approximately 100 countries. The second phase, commencing at April 9th, targets countries with significant trade surpluses with the United States, imposing higher tariffs such as 34% on China, 20% on the European Union, and 46% on Vietnam. In retaliation for the US tariffs, China imposed reciprocal tariffs on all American imports. Additionally, China escalated its response through export controls, antitrust investigations, and by placing certain US companies on its unreliable entity list. As the US continues its unilateral trade policies, it is likely that more nations will join the growing wave of counteractions. However, not all of the Trump policies pose economic headwinds. Amid these challenges, there are also factors that could boost growth and market performance. Lower corporate taxes could boost after-tax profits and spur investment, while personal income tax cuts may support household spending and encourage growth. Additionally, if Trump follows through on his campaign promises to invest heavily in infrastructure and defense, this massive fiscal spending could provide a near-term boost to the economy. With these factors in play, the Federal Reserve may resume interest rate cutting cycle, potentially exceeding the market expectations of 2 cuts by delivering 3 to 4 cuts by the end of 2025. These high tariffs, combined with the slowdown and subsequent pause in the Fed interest rate cuts, had begun to push inflation up. Additionally, high tariffs drive up costs for manufacturing and for retail industries that depend on imported raw materials, squeezing profits and slowing economic growth. Notably, the annualized GDP growth rate fell to 2.3% in the fourth quarter, down from 3.1% in the third quarter of 2024. Looking ahead, if higher tariffs are imposed to more countries, corporate costs could rise, squeezing profit margins and putting further pressure on stock valuations. Even if companies try to pass some of these costs on to consumers, higher prices could weaken demand, leading to lower revenues, and additionally, further retaliatory measures from foreign counterparts could dampen US economic growth and extend additional pressure on the stock market. To sum up, although the tariff policies has intensified market pressure, we remain cautiously optimistic about the US stock market. The combined effects of tax cuts, fiscal expansion, and precautionary rate cuts are likely to offset some of the headwinds and provide supportive environment for the market moving forward. As we move into the second quarter of 2025, strategic stock selection is essential. Despite ongoing market adjustments, significant opportunities are emerging right now. Let's start diving into some key sectors. First, the increasing AI data center demand drives nuclear energy growth with improved reliability and lower costs. Meanwhile, Trump's pro-energy policies and global demand recovery are boosting oil and gas profitability, working towards ensuring stable investor returns. Next, powered by adjustments in AI technology and deregulation, the financial sector appears to be exhibiting strong growth momentum, potentially contributing to a dual surge in profits and stock prices. Additionally, following the latest earnings from the 5 large AI scalers, AI spending looks like it hasn't slowed down at all, and investment opportunities may still exist. Given Nvidia's high valuation, however, investors might consider exploring other companies along the broader AI supply chain in search for potential bargains. With this sector's trend in mind, let's move on to explore and assess 10 stocks that have promising potential right now. The first stock is Micron Technology. Micron is engaged with the design and production and sale of memory chips, which are actually different from CPUs and GPUs. The company is one of the 3 major players in the industry, which implies that the industry itself has a very high barriers of entry. Historically, the industry was notorious for being very cyclical, but what makes Micron attractive now is the exposure towards high bandwidth memory chips, a product growing at 25% CAGR and crucial for AI. As the only American player among the top 3, Micron benefits from the solid backing by the US government in the form of subsidies. Moreover, Micron Micron closely collaborates with NVIDIA, a very strong position to capitalize on the growing trend of AI. Second stock is Uber. Uber is the leading ride-sharing and food delivery marketplace in the world. With 170 million monthly customers and 8 million drivers across 70 countries, Uber business model is very difficult to replicate. Revenue right now is growing at a healthy double-digit growth, which is driven by more frequent use of services and aggressive expansion overseas. The cost structure of the company is very fixed, allowing for strong operating leverage and even higher growth in earnings. In terms of price, the market previously punished Uber a bit too severely over the threat from autonomous vehicles. However, at this point, these kind of risks seem quite limited, as AV companies now see Uber as a partner due to their strong value proposition, rather than just being a direct competitor. Right now, Uber is the most recent addition to the Bill Ackman's holdings, and this is often seen as a very good sign for long-term investors. The third company that we have in mind is Alphabet. Alphabet dominates the search engine and the video sharing businesses, and is one of the two biggest online advertisers, along with Meta. The advertising business of Alphabet serves as a very solid cash cow, financing its other business ventures. Currently, Alphabet is among the largest AI scalers and one of the top 3 cloud providers globally. Its cloud business, with its rapid growth of over 20% and very early stages of profitability, could be the main tailwind for the earnings to grow in the future. Alphabet stock has been weighted down by some uncertainties with regards to the surrounding recent antitrust legal process. But with more clarity throughout the year, Alphabet stock is poised for re-rating. Meta owns and operates the largest social media networks globally: Facebook, Instagram, and WhatsApp. Meta derives almost all of its revenue from advertising, boasting an operating margin of 40%, which is a very good number. Meta appears to be very well positioned for the future growth due to its strong AI initiatives. With the emergence of open source language models, Meta can utilize the capabilities of its Llama family of models and become a frontrunner in AI. Some of the platforms that is under Meta, like WhatsApp and Threads, are still in the very early stages of monetization. Therefore, the company's earnings can be expected to grow steadily over the coming years. SuperMicro Computer provides high-performance server technology solutions. For fiscal 2026, SuperMicro set a revenue target of $40 billion, which is significantly higher than the previously expected $30 billion and more than double of the current annual revenue. The high expectations of growth are backed by their expertise in liquid cooling technology, designed to handle the highest levels of computational powers from AI and deployable in a much faster speed than the products of their competitors like HP and Dell. On the top of that, SuperMicro strengthened its partnership with NVIDIA, incorporating the newest and most powerful products of the company into its data center solutions. 6. We have Broadcom. Broadcom is a leading designer and developer of digital analog semiconductors. It has cemented its position as a critical player in various markets, including wired infrastructure, wireless communications, enterprise storage, and industrial applications. The latest quarter of revenue growth was 25%, and this growth rate is expected to be sustained in the coming quarters, driven by the VMware integration, enterprise clouds adoption, and in general the growth of AI infrastructure. Broadcom also has a proven track record of operational efficiency, with operating margin of a solid 40%, with further synergies to be potentially realized from the deal with VMware. Constellation Energy is the largest US producer of carbon-free electricity, generating 10% of the nation's clean energy through its leading nuclear fleet, hydropower, wind, and solar. Benefiting from surging electricity demand driven by the AI data centers, Constellation, as the largest nuclear operator in the US, delivers reliable, stable, and clean energy. Analysts expect over 20% growth in EPS and more than $2 billion of free cash flow by 2026. At number 8, we have Occidental Petroleum. Occidental, one of the top 5 American oil and gas companies, is dedicating almost 3/4 of its $8 billion capex in 2025 to high-return shale and oil and gas projects. A recent $6 billion asset divestiture plan seemed to move the company closer to its $15 billion debt reduction target, all while maintaining a stable cash flow that supports a generous 4 to 5% of dividend yield. Goldman, a leading name in the financial industry, is focusing on investment banking and trading funding growth through its One Goldman Sachs strategy. Unlike competitors like JP Morgan, it emphasizes high-margin institutional services over retail banking. Goldman looks well-positioned to dominate advisory and underwriting businesses, as we expect these two industries to rebound after a weak period in the last couple of years. Additionally, its heavy investment in AI-powered trading and risk management platforms could place the company on the forefront of the banking industries in 2025. And at number 10, we have WellsFargo. WellsFargo, the fourth largest bank in the United States, is a retail banking giant with over 4,000 branches and 1.4 trillion deposit assets. Its diversified business spans across consumer lending, wealth management, and commercial banking. A new wave of Trump-era deregulation could boost the capital return policies such as dividends and buybacks, while expected interest rate cuts may spur further loan demand. Additionally, WellsFargo seems to be accelerating its digital transformation to capture growth in strong developing markets like young clients and SMEs, enhancing the growth potential in 2025. These sectors and stocks present potential growth opportunities in 2025, driven by a combination of technological advancement, favorable policy changes, and strong market positioning. However, and as always, investors should remain mindful of market volatility and evolving regulatory landscapes. For an in-depth analysis of TradingKey's 2025 outlook, check out our websites, and we can see the link down in the description. What's your take on the market direction right now? We would love to hear from you. Share your insights and stock picks in the comments down below.